Hello, I'm Todd McManus, and I worked with Colin, Jack, James, Ryan, and Zach on the book Too Big to Fail. It was written by Andrew Ross Sorkin and takes a reader through the credit crisis from the point of view of various Wall Street CEOs and government officials, providing a detailed look into the decisions made on an everyday basis as companies tried to stay afloat and the government tried to prevent collapse of the financial system.
Too Big to Fail offers the perspectives of many executives, government officials, and other people in the middle of the crisis, but nobody's name was mentioned more than Hank Paulson's. As the Secretary of the Treasury, Paulson became one of the most important people in the entire world, which came with plenty of scrutiny. Having formerly been the CEO of Goldman Sachs, he was constantly worried about how the public would perceive his communication with Wall Street. Ben Bernanke was the chairman of the Federal Reserve, and Tim Geithner was the president of the Federal Reserve Bank of New York. These two, along with Paulson, formed a big trio who were constantly in contact with the banks and eventually got him on board with TARP. Dick Fuld was the CEO of Lehman, nicknamed the Gorilla. Much of the book details the build-up to the collapse of Lehman and how he frantically and reluctantly had to search for a buyer. Jamie Dimon was the CEO of JP Morgan in 2008 when they acquired Bear Stearns and was heavily involved in the meetings with the other banks and government officials. He is the only one of the CEOs in the book remaining in his position. Finally, Robert Willemstad was a relatively new CEO of AIG who had to deal with their collapse and subsequent bailout. Additional important names from the book are listed below.
And now I'll discuss key terms. A bank holding company is a company that controls one or more banks, but does not necessarily engage in banking. These types of companies also must follow standards and regulations given by the Federal Reserve. In Too Big to Fail, the resolution at the end of the book is for true investment banks, like Goldman Sachs or Morgan Stanley, to become bank holding companies so that way they can access the Fed's credit facilities. And this is essentially what they give up in order for being saved. The discount window is a type of monetary policy that allowed institutions to borrow from a central bank, here being the Fed, on a short-term basis for liquidity. However, throughout the recession, the terms for repayment on the loans were extended from overnight to 90 days, and the rate on the loans dropped over 5% down to 0.5% in late 2008. Conservatorship is a legal tactic where one entity, here the U.S. Treasury, is allowed to manage the financial affairs of another entity, here Fannie Mae and Freddie Mac. The conservatorship was funded using U.S. taxpayer dollars in 2008 and will end once all government-sponsored entity debts are repaid. However, it's worth noting that in 2021, both Fannie and Freddie are still under conservatorship. Mortgage-backed securities are an investment like a bond, where underlying mortgages are pooled together and pay principal and interest based on if the homeowner makes payments towards the mortgage. These MBSs may be a type of collateralized debt obligation, called a CDO as well, or part of a CDO, where a pool of assets used as collateral is tranched according to risk and pay off if the underlying assets pay off. In the credit crisis, these securities were inaccurately rated for risk and are what kept the housing bubble afloat for so long. As insurance on the CDOs, banks purchase credit default swaps, or CDSs from the likes of AIG, which are essentially derivatives that pay when a homeowner does not pay. In the case of the 2008 recession, AIG did not have to pay on the CDS unless its own credit rating or collateral hit threshold amounts. In September 2008, AIG's credit rating was lowered below the threshold, and the Federal Reserve had to step in with an $85 billion loan so the failing company could make good on its swaps. A capital injection is a type of investment of capital into a company, project, or investment. During the housing crisis, it was the Federal Reserve money like the $85 billion issued to AIG or the premium share purchases in banks. Moral hazard is when a company provides false information prior to entering a contract or has incentives to take risk assuming they will be bailed out. In the crash, banks did this by collateralizing and pooling risky assets with the assumption that AIG would bear the risk thanks to CDSs. Toxic assets are assets for which the market has fallen drastically and no fair value exists. In this case, CDOs and CDSs. And finally, TARP, or the Troubled Asset Relief Program, was initially liquidity from the Treasury to mortgage markets through repurchasing of toxic MBSs, though later became investing in financial institutions to keep them afloat. This will be discussed more in depth later on, but for now, let's move on to the timeline of the credit crisis.
The book opens in March 2008, but there were several events leading up to the fall of Bear Stearns that are key in understanding the book. First, in early 2007, the housing bubble begins to show itself, as smaller lending firms show losses on mortgages and begin to fail and go bankrupt. Then, later in 2007, these losses make their way to larger banks, resulting in large write-downs on mortgage-backed securities. Next is where the book begins, with the sale of Bear Stearns to J.P. Morgan Chase at $10 a share, negotiated and propped up by the Fed, and a $30 billion purchase of toxic assets. This introduces the idea of a business being too big to fail, and at the subsequent congressional inquiry, the issue of moral hazard is introduced for one of the first times. The next major event was the setting of Fannie Mae and Freddie Mac into conservatorships, furthering the thoughts of many that the Treasury and Fed officials were socialists looking to take over private businesses. Then the book covers the bankruptcy of Lehman, where the Fed allowed them to fail, something that Ryan will go more in depth on later, and the stabilization of AIG, which was contrary to the Fed decision on Lehman, solidifying AIG as too big to fail. The book finishes talking about the Troubled Asset Relief Program, which authorized hundreds of millions of dollars to repurchase troubled assets from financial institutions. Overall, the book is a story of normal people doing their best with limited information to predict and recover from the financial disarray of the 2007-2008 crisis.
So one of the major plot lines throughout the book was obviously the fall of Lehman Brothers. To give you a little background, I'll start why it happened. So Lehman Brothers was extremely levered, like most Wall Street firms at the time, and had debt-to-capital ratios of 32 to 1. This caused, when the economy was doing poorly and the real estate market crashed, for Lehman Brothers to have $6.5 billion worth of toxic CDOs on its balance sheets. Another thing that contributed to it, but did not directly, was short sellers. They caused Lehman's stock price to drop at even more absurd rates. You would think that investors would have caught on to this earlier and prompted management to make a change. However, Lehman Brothers used fair value accounting principles and other accounting tricks to hide their problems. They chose to only write down or take a loss of $200 million worth of CDOs, when in reality they should have taken more of losses close to $3 billion. They also boosted earnings by recording extra revenue when the price of the bonds were decreasing. This heavily misled investors as they were not making any actual money. Lastly, they used Repo 105 to artificially decrease the amount of debt it had on its balance sheet. Doing this, they would sell securities for cash, use the cash to pay down the debt, and then just return the cash and that debt back on their balance sheet when the financial statements had been issued. They actually had a number of deals that were offered to them that would have saved the shareholders billions of dollars. For example, the Korean Development Bank actually offered Lehman Brothers 1.25 times their book value and a premium on their current share price. However, Dick Fuld did not want to admit his failure nor lose his job, so he turned down the deal, which cost the shareholders, like I said before, billions of dollars. This helped him kind of become the villain of Wall Street. It kind of seemed as if the only thing that would save Lehman Brothers was a government bailout. However, after kind of the backlash and the anger that the government received from the Bear Stearns bailout, they were not willing to do that again and use public money to bail out a private institution that did nothing for the general public. Lastly, the only deal that seemed like it had possibly a chance of saving Lehman Brothers was the deal with Barclays. Barclays wanted to expand to the U.S. and saw a distressed sale of Lehman Brothers as a way to do so. However, the British government would not let this deal go through due to the fact that it did not want to import the U.S. problems. So in the end, the deal did not happen. And this kind of set the stage for the other bankruptcies and falls to come, like AIG. What was kind of different about those, though, was that the government saw that the impact that the Lehman bankruptcy had on all these other institutions and realized they cannot let that happen again. So they decided to bail out the other institutions.
One of the biggest issues during the financial crisis that the government had to deal with was who would fit the definition of too big to fail because of its exposure across the whole financial system. At the time, Lehman was one of the largest U.S. banks and seemed to fit this definition. However, when the government considered other factors, including that there was really no really interested private buyer for the firm, and the bank really had relatively worse assets on its balance sheet, the government decided that it really could not have had a 100% government-backed bailout of the firm. This really leads to the next issue on this slide of really the worry of what the public perception of these bailouts would be, given that they were using taxpayer dollars to save the mistakes of people who took on so much risk. There was really a lot of behind the scenes conversations that the book highlights of government leaders, especially Hank Paulson, talking about how much public outrage there would probably be after these bailouts were announced to the public. And one thing that I think was especially difficult for them is that it's really hard for people who do not have, much of a finance background to understand why some of these bailouts were probably necessary. That's not to say that banks shouldn't have been responsible for the types of risky products they were offering at the time, but without any bailout, the results likely would have been much worse than they already were. And I really think another issue that kind of goes along this and is highlighted on this slide is that I think it was interesting to see that the ties that a lot of these government officials, mainly Hank Paulson, had with Goldman because of their previous employment at that bank. A lot of times while reading the book, it seemed that the government felt limited with options regarding bailouts because they did not want to make themselves seem that they were giving favorable treatment to Goldman relative to the other banks. All in all, this issue probably wasn't one with great magnitude, but it could have played a bigger role had the government been in a position to bail out Goldman Sachs directly when they were in a worsening financial position towards the end of, really kind of towards the end of this crisis. I think finally, one key strategy that the government really needed to accomplish when they were implementing TARP, which will be talked about in greater detail on the next slide, was really how to prevent further panic. And so by forcing all the top banks to partake in the program and borrow directly from the government, it was hard for the public to distinguish which banks were really in the worst position. I think this is also interesting to see how this played out at the beginning of COVID as well, when multiple top banks, including JP Morgan and Bank of America, borrowed directly through the discount window, despite not being in any really financial distress. They just really wanted to show that the action of borrowing from the discount window doesn't necessarily reflect any bank is in a troubling or risky situation.
The Troubled Asset Relief Program, commonly referred to as TARP, was, with the significant help from President of the New York Federal Reserve Tim Geithner and Assistant Secretary of the Treasury Neil Kashkari, Secretary of the Treasury Hank Paulson's plan to stabilize Wall Street's biggest institutions as they suffered through significant liquidity crises. The main function of the legislation was to purchase $500 billion of Wall Street's, AIG, and Fannie and Freddie's troubled, toxic, and distressed assets. The plan was initially rejected by U.S. Congress, garnering criticism for being too friendly to the banks that were looked at as irresponsible risk takers, especially as this legislation was to be funded using taxpayer money. Republicans thought the plan was socialist, as it was using public funds so that the government could take a stake in America's oldest private financial institutions, while Democrats thought the plan was too coddling to the interests of Wall Street elites. TARP was eventually passed and resulted in almost all of Wall Street's banks and financial institutions being forced to take the money to relieve some of the stigma associated with taking quote-unquote bailout money. Retrospectively, the effectiveness of TARP can still be debated as big bonuses were given out to many bankers, bringing up questions of whether TARP was really needed. However, the immediate and major results of TARP included approximately 1 million jobs being saved and much of the initial funding requested being paid back to the government shortly thereafter.
There are many themes from the book that are still relevant today. First, the concept of too big to fail set a precedent that is tough to see disappearing should a similar crisis arise. If, for instance, an institution's failure could, significantly hurt the economic system, they likely would receive assistance from the government. Both Tim Geithner and Robert Williamstad have affirmed that the concept of too big to fail is likely not going away. That creates an enduring worry of moral hazard. If the government remains as a backstop, what is there to prevent these companies from taking on excessive risk? There also remains a general distrust of the elites who are supposed to prevent us from seeing a crisis like this, but could not. Campaign donations from Wall Street have become a talking point with negative connotation during the 2020 presidential campaigns, and recently the rise of retail investors on Reddit have painted a sort of Wall Street versus Main Street dynamic. Sorkin also points to Brexit and Bitcoin as global signs of distrust in the system. Finally, companies today are more levered than ever as we see corporate debt levels hitting all-time highs. This sparks a crucial question from the book. Wall Street was bailed out once. Have they really learned their lesson? All in all, we really enjoyed this book and highly recommend that everybody reads it. It's not the sort of book that will bore you with technical details, but rather it offers a behind-the-scenes look at the big players of the financial crisis. Thank you.